right, everyone, get ready for a deep dive. Today, we're tackling automobile insurance regulations, and we're zeroing in on South Carolina.
Sounds exciting.
It is. We got excerpts from a legal textbook chapter that breaks down the entire system in the Palmetto State.
Oh, wow, a legal textbook, so we're getting into the nitty-gritty.
Absolutely. By the time we're done, you'll be the go-to person for car insurance trivia at your next dinner party. You'll be dropping knowledge bombs left and right.
I like the sound of that. All right, let's dive in.
So where do we even begin with something as complex as insurance regulation?
Well, believe it or not, insurance regulation in the U.S. actually started at the state level, not federal.
Really? I would thought it was the other way around.
Nope. We're talking way back in the day, with early insurance companies getting their start through special charters from state legislatures.
So it was the Wild West of insurance, with each state doing its own thing.
Pretty much.
Yeah.
And speaking of the early days, one of the earliest insurance companies in America popped up right here in Charleston, South Carolina.
No way. Right here in Charleston.
Back in 1736. They called it the Friendly Society of Charlestown.
I love that name. The Friendly Society. It sounds so quaint.
It does, doesn't it?
Mm.
But unfortunately, they met a rather ironic end.
Oh, no. What happened?
A few years later, a big fire swept through Charleston, and the Friendly Society went up in smoke.
Oh, the irony. The very thing insurance is supposed to protect against took them down.
Right. It really highlights how long the need for insurance has been around.
Definitely. It's a timeless need, it seems. So how did states solidify their control over insurance? I imagine there were some legal showdowns along the way, right?
You bet. The Supreme Court played a major role in shaping how insurance was regulated.
I could imagine. What were some of the key cases?
Well, a landmark case called Paul v. Virginia in 1869 was a big win for states' rights. The Supreme Court ruled that insurance wasn't interstate commerce.
So that gave states the power to regulate it.
Exactly. But the story doesn't end there.
Ooh, I sense a plot twist.
Fast forward to 1944, and we get the case of United States v. Southeastern Underwriters Association. This ruling completely flipped the script on Paul v. Virginia.
What happened?
The court said insurance was interstate commerce, shaking things up big time. Suddenly, there was this massive tug-of-war between state and federal power over insurance.
Wow. So who ended up winning that tug-of-war?
Well, Congress stepped in to settle the score with the McCarran-Ferguson Act in 1945. It essentially put states back in charge of regulating insurance.
Okay, so a win for states' rights.
Yes, but with a catch. Federal law could still supersede state law if it's specifically related to insurance.
Ah, so a bit of compromise then.
Exactly. Now, bringing all this back to South Carolina, their structure for insurance regulation is similar to most other states.
Okay, so let's talk about South Carolina specifically. Who are the major players calling the shots on auto insurance in the Palmetto State?
Well, at the top, you've got the South Carolina Department of Insurance. It's led by a director appointed by the governor.
So they're the ones making sure all the insurance laws passed by the legislature are actually enforced.
Exactly. They're the state-level regulators.
Makes sense. Now, what about the feds? Do they have any say at all in South Carolina?
They do, and their influence has actually been growing in recent years.
Oh, how so?
Well, for instance, the Dodd-Frank Act of 2010 created the Federal Insurance Office, or FFIO.
FFIO, okay.
What do they do?
Their main job is to keep an eye on the insurance industry, monitoring, analyzing, offering advice.
So more of a watchdog than a rule maker.
Exactly. Then you've got the Gramm-Leach-Bliley Act of 1999, or GLBA for short. You might remember that one.
Oh, yeah, GLBA, that rings a bell. Didn't it kind of blur the lines between banking, insurance, and securities?
You got it. It turned the financial world into a giant melting pot.
I remember that causing a lot of discussion back then.
It did. And because of that blending of sectors, there were more national considerations to take into account. So with all these players involved, state regulators, federal agencies, who exactly is being regulated in South Carolina, it sounds like a crowded field.
Well, first and foremost, you've got the insurance companies themselves.
That makes sense. They're the ones providing the policies.
Right. They need licenses to operate, have to meet strict financial standards,
Yep.
and they're always being checked to make sure they're financially sound and following the rules.
Yeah, you definitely don't want your insurance company going bankrupt when you need them most.
Exactly. But it's not just the companies. You've also got all the people who sell insurance.
Right, the ones we used to call insurance agents.
Well, actually, South Carolina doesn't use that term anymore. They replaced it with producer.
Oh, interesting. So it's all about the producers now.
That's right. And just like insurance companies, producers and brokers need licenses too. And there are regulations to make sure they're trustworthy and knowledgeable.
Okay, that makes sense. What about the people who handle things when, accidents happen?
You're talking about adjusters.
Yeah, adjusters, appraisers, those folks.
Right, well, there are actually a few types of adjusters.
Yeah.
You've got the ones who handle the claims process, appraisers who assess damage to your car, and then public adjusters.
Public adjusters, what's the difference?
Public adjusters work for you, the insured person, not the insurance company.
Oh, so they're on my side.
Exactly. In South Carolina, public adjusters have to be extra careful because they have to operate within certain boundaries so they don't accidentally end up doing something that could be considered practicing law without a license.
Wow, so there's a fine line there. Interesting. What about those companies that help people pay their premiums? I remember using one of those years ago.
You're thinking of premium service companies.
Yeah, those are the ones.
They help insureds manage their payments. But they operate under tight regulations, especially after South Carolina did away with the Rule of 78s calculation back in 2001.
What was the rule of 78s?
It was this complicated formula they used for premium financing, and it sometimes led to problems for consumers. Getting rid of it was a big win for consumer protection.
I see. So it's all about making sure those premium service companies are playing fair.
Absolutely. Now, you might recall we talked about that Gramm-Leach-Bliley Act earlier, the GLBA.
Yes. Didn't it have a provision called NARAB 2, which was supposed to simplify things for insurance producers who wanted to work in multiple states?
That's the one. Well, the initial idea was for states to set up these agreements for producer licensing reciprocity, but that didn't quite pan out as planned.
So what happened?
Well, in 2015, ARAB 2 became law. It's basically a national clearinghouse that streamlines the licensing process for producers who want to work in multiple states.
So even though insurance is mostly regulated at the state level, the feds still have a hand in things.
Precisely. It's this intricate dance between state and federal influence, and it's constantly evolving. But now, how about we shift gears and delve into the history of auto insurance in South Carolina? It's had quite a few twists and turns over the years.
Oh, yeah. Let's hear it. I know they had this mandate to write policy for a while. What was that all about?
From 1974 to 1997, insurers in South Carolina were actually required to accept all risks no matter what.
Wait, so no matter how terrible a driver you were, they couldn't refuse to cover you?
That's right, which, as you can imagine, led to some interesting consequences.
So basically, good drivers were stuck paying higher premiums to cover the bad drivers.
You got it. It created this imbalance where lower-risk drivers were essentially subsidizing the higher-risk ones.
It doesn't seem very fair, does it?
Not really. And it led to some problems for the insurance market as a whole. To try and address this, South Carolina created something called the South Carolina Reinsurance Facility.
What was that? Some kind of safety net for the insurance companies?
You can think of it that way. It was basically a residual market for high-risk drivers who couldn't get coverage in the regular market.
So if you were a terrible driver, you could always turn to this reinsurance facility as a last resort.
Exactly. But as you can imagine, it quickly became overwhelmed. At one point, the reinsurance facility was writing over 40% of all the auto insurance policies in South Carolina.
Wow, 40%. That's a huge chunk of the market. It sounds like it wasn't really a long-term solution.
You're right, it wasn't sustainable. Something had to change. The turning point came in 1997 with Act No. 154.
Act No. 154. Okay, so this was a big one.
A game changer. This act brought competition into the auto insurance market and gave insurers the ability to underwrite risks again.
Underwriting, you mean like actually assessing the risk of insuring someone?
That's right. They could look at a driver's history, age, type of vehicle, location, all those factors that help determine how likely they are to file a claim.
Ah, so they were finally able to differentiate between good drivers and bad drivers and charge accordingly.
Precisely. It was a move away from that mandate to write policy, and it gave insurers more freedom to choose who they wanted to cover and how much they wanted to charge.
Okay, but I'm guessing there were some concerns about this new approach, like what's to stop insurers from discriminating against certain groups of people?
That's a very valid concern, and it was something that lawmakers in South Carolina took very seriously. Thankfully, Act No. 154 also included some important anti-discrimination provisions.
So what did those provisions say?
Well, for starters, insurers are prohibited from refusing to issue a policy based on factors like a driver's age, sex, their location in the state, race, color, creed, national origin, ancestry, marital status, or their income level.
Wow, that's a pretty comprehensive list. They were really trying to make sure that access to insurance was fair and equitable.
Exactly. They wanted to prevent discrimination based on those personal characteristics. But there is one interesting exception to those anti-discrimination rules.
Oh, what's that?
Insurers are allowed to take a driver's occupation into account when setting rates.
Wait a minute, their job. How does that work? Wouldn't that open the door to all sorts of bias and unfair treatment?
You're right, it could be a problem if it wasn't carefully regulated. But the law is very specific about how this exception can be used. Insurers can offer policies that are tailored to specific professions or even religious groups, but they have to be able to justify those rates based on actual data and actuarial analysis. They can't just arbitrarily charge someone more because of their job title.
Okay, so they have to prove that certain professions or groups actually represent a different level of risk. It can't just be based on stereotypes or assumptions.
Exactly. It's about finding that balance between accurate risk assessment and preventing unfair discrimination. Now, shifting gears a bit, let's talk about how insurance companies actually go about determining those rates. Remember how we talked about South Carolina having that strict prior approval system for rates before Act Now 154?
Yeah, it sounded like a real pain for insurance companies to have to get the state's permission for every little rate adjustment they wanted to make.
It was definitely a cumbersome process. But Act number 154 brought some big changes to that system. They introduced what's called a modified file and use system, which gave insurers a bit more flexibility to adjust their rates without having to jump through all those hoops.
So they had a little more freedom to respond to market changes and adjust their pricing.
Right. For example, they're allowed to make increases or decreases of up to 7% annually without having to get prior approval from the state. It streamlines things and allows for a more dynamic market.
Okay, so they have some leeway to tweak their prices within certain limits, but what happens if they want to go above that 7% threshold?
If an insurer wants to increase rates by more than 7% in a year, they still have to get prior approval from the state. It's a way to ensure that any big rate hikes are justified and not just arbitrary price gouging.
So it's a balancing act, giving insurers some flexibility but also protecting consumers from unjustified price increases.
Exactly. But even this system has seen some recent updates. Remember we talked about how insurers can now request up to 2 rate increases per year?
Oh, yeah, that's right. Didn't that go into effect fairly recently?
It did. Since May of 2022, insurers have been able to request up to 2 rate increases per year. One of those falls under the file and use system we just talked about, and the other requires prior approval.
Interesting. So they have a bit more flexibility now, but how do they actually determine what those rates should be? What factors do they consider? Are there any rules about what they can and can't use?
Great question. And this is where those anti-discrimination provisions we talked about earlier come back into play. Insurers can't just use any old factor to set rates. They have to make sure they're not discriminating against protected groups.
So things like race, religion, income level, those are all off limits.
Exactly. But there are certain factors that they are allowed to consider, such as what's known as territorial plans.
Territorial plans, what are those?
These are adjustments to rates based on where a car is primarily garaged or driven. So, for example, if you live in an area with a high crime rate or a lot of accidents, your premiums might be higher than someone who lives in a rural area with less crime and fewer accidents.
Okay, that makes sense. It's kind of like how your location can affect your homeowner's insurance rates too. Some areas are just riskier than others.
Precisely. But these territorial plans can't be used in a discriminatory way. They have to be based on legitimate differences in risk. They can't redline certain neighborhoods or penalize people based on their socioeconomic status.
So the state's keeping a close eye on those territorial plans to make sure they're not being used to unfairly target certain groups of people.
Exactly. Now, another factor that insurers can take into account is, of course, the driver's history behind the wheel. There used to be a system in place called the Uniform Merit Rating Plan, but that's gone now.
What was that system all about?
The Uniform Merit Rating Plan was based on a driver's record, but it only looked at the past 3 years. So if you had a few accidents or tickets more than 3 years ago, those wouldn't be held against you when calculating your rates. But that's changed.
So they're not limited to just the past 3 years anymore.
That's right. Insurers can now consider a driver's entire driving history when setting rates. So even if you had a fender bender a decade ago, it could still affect your premiums today.
Wow, so those past mistakes can really come back to haunt you. It seems like a double-edged sword. On the one hand, it makes sense to consider someone's full driving record, but on the other hand, it means those old incidents can follow you around for a long time.
It's about finding that balance between accurate risk assessment and giving people a chance to improve their driving habits. Now, this brings us to a very interesting and sometimes controversial topic, the use of credit scores in auto insurance.
Ah, yes, the credit score connection. I've always been curious about this one. How can my credit score possibly be related to my driving skills?
It does seem a bit strange at first glance, doesn't it? But statistically speaking, there's a correlation between a person's credit history and the likelihood that they'll file an insurance claim. Studies have shown that people with poor credit tend to file claims more often.
Really? I never would have guessed that. So there is some logic to it. They're not just randomly pulling our credit scores to be nosy.
Exactly. It's not about judging your financial situation or making assumptions about your character. It's about using data to assess risk.
But I still have to admit, I feel a bit uneasy about it. It feels like an invasion of privacy to have my financial history factored into my car insurance rates.
I understand that concern,
Right.
and a lot of people feel the same way. It's important to know that South Carolina does permit the use of credit scoring in auto insurance, but there are regulations in place to protect consumers.
Okay, so what kind of safeguards are there?
Well, first and foremost, insurers are required to tell you up front that they're using your credit report to help determine your rates. They can't just do it behind your back.
At least they have to be transparent about it.
Exactly. And they're also required to keep those credit reports on file so they can be inspected if needed. They can't just pull your credit information and then disappear with it.
Okay, that makes me feel a little bit better knowing that there are some checks and balances in place. Speaking of data, what about all those devices that track your driving? It seems like those are becoming more and more common these days.
You're talking about usage-based insurance, or UBI. It's definitely a hot topic in the insurance world right now. Those devices, sometimes called telematics devices, can collect a ton of data about your driving habits.
Like how fast I drive, how hard I brake, how many miles I put on my car, that sort of thing.
Exactly. And that data is transmitted back to the insurance company, who can then use it to adjust your rates accordingly. The theory is that it rewards safe drivers with lower premiums and encourages everyone to be more mindful behind the wheel.
It's kind of a futuristic way of approaching car insurance. I guess you could say it's bringing the industry into the digital age. But I have to admit, the thought of having my every move tracked while I'm driving feels a little unsettling.
You're not alone in feeling that way. Privacy concerns are a big issue when it comes to telematics and usage-based insurance. There are a lot of questions about how that data is being used, who has access to it, and whether it could be used in ways that we haven't even thought of yet.
It almost feels like something out of a science fiction movie, like Big Brother is watching my every move on the road.
It definitely raises some interesting questions about privacy and data security in the digital age. Speaking of new technologies and evolving landscapes, another development that's really shaken up the auto insurance industry is the rise of ride-sharing services like Uber and Lyft.
Oh, yeah, that's a good point. It seems like everyone's using those apps these days. It makes you wonder how traditional auto insurance policies handle that whole situation.
It definitely created a unique challenge for the insurance industry. Personal auto insurance policies were designed for people using their cars for personal use, not for commercial purposes like driving for a ride-sharing company.
So if I got into an accident while driving for Uber or Lyft, my regular auto insurance wouldn't cover it.
That's right. It was a big problem because those personal policies typically exclude coverage for commercial use. It left a lot of drivers and passengers in a very vulnerable position.
So what did they do about it? Did they come up with a whole new type of insurance just for ride-sharing drivers?
That was part of the solution. Many states, including South Carolina, passed laws to address this issue. In 2015, South Carolina enacted Act Number 88, which made some key changes to the insurance laws surrounding ride-sharing.
Okay, so what did Act No. 88 do?
Well, one important change was that it allowed personal auto insurance policies to specifically exclude coverage for ride-sharing activities. So your personal policy won't kick in if you're logged into a ride-sharing app, even if you haven't accepted a ride yet.
So you can't just rely on your regular insurance if you're out there looking for passengers.
Exactly. To fill that gap in coverage, Act No. 88 also requires ride-sharing companies like Uber and Lyft and their drivers to have separate, higher limits of insurance when they're actively engaged in a ride.
So there are basically two layers of insurance now. Your personal policy for when you're driving for personal reasons, and then this separate higher limit policy for when you're driving for a ride-sharing company.
You got it. It's a way to ensure that everyone involved is adequately protected, whether you're the driver, the passenger, or someone else on the road.
It's amazing how the laws have to constantly adapt to these new technologies and business models. The world's changing so fast, and the insurance industry is trying to keep up.
It's a constant game of catch-up. And speaking of change and new technologies, we can't ignore the impact of big data on the insurance industry. We've talked about credit scoring and telematics, but this is just the tip of the iceberg when it comes to the ways that data is being used in insurance.
It sounds like a whole new frontier. What other ways are they using big data?
Two areas where big data is having a major impact are price optimization and information security. Both are generating a lot of discussion and debate because they raise some important ethical and regulatory questions.
Okay, so let's break those down. Price optimization. What exactly does that mean?
Imagine this. An insurance company is using your online activity, your browsing history, your shopping habits, even how often you buy a new phone, to figure out how much to charge you for car insurance.
Wait, what? They're looking at my online shopping and my social media to figure out my car insurance rates? That just seems wrong on so many levels.
It does raise a lot of concerns, that's for sure. The idea behind price optimization is that all this data can help predict your behavior as a consumer. They're trying to determine things like how likely you are to shop around for lower rates, or whether you'll easily accept a price increase without pushing back.
So it's less about assessing my risk as a driver and more about exploiting my consumer habits.
That's the criticism that many people have of price optimization. It raises questions about fairness and discrimination. Should two people who pose the same risk on the road pay different premiums just because one is more price sensitive than the other?
It feels like they're crossing a line when they start using data that has nothing to do with driving to determine my car insurance rates.
It's definitely a gray area, and it's something that regulators are keeping a close eye on. In South Carolina, the good news is that their regulations generally prohibit this type of price optimization. They require that rating factors have to be related to actual risk, not just predictions about your behavior as a consumer.
That's good to hear. It gives me a bit more confidence that they're trying to keep things fair. But all this talk about data collection brings up another concern: information security. If insurance companies are collecting all this information about us, are they doing enough to protect it?
That's a very valid question, and it's something that regulators are taking very seriously. A data breach involving insurance records could be devastating.
No kidding. Think of all the personal information they have: social security numbers, driver's license numbers, bank account details. It's a goldmine for identity thieves.
Exactly, so the stakes are very high. And with hackers becoming more sophisticated all the time, it's a constant battle for companies to stay one step ahead.
So what are they doing to beef up their security?
Well, in South Carolina, they've taken a pretty proactive approach. In 2019, they passed the Insurance Data Security Act, which sets some pretty strict standards for cybersecurity in the insurance industry.
So they can't just rely on those basic antivirus programs anymore.
Nope. This act requires a much more comprehensive approach to data security. Companies had to conduct regular risk assessments, develop incident response plans, train their employees on cybersecurity best practices, all sorts of things.
So they have to be prepared if something does happen, not just hope for the best.
Right. Prevention is key, but so is being able to respond quickly and effectively if a breach does occur. And this act also requires them to notify affected individuals promptly if there is a breach. No more sweeping it under the rug.
It sounds like they're finally taking data security seriously, which is reassuring. But let's shift gears for a moment and talk about something a little more basic: financial responsibility.
Ah, yes, the foundation of any sound auto insurance system.
Exactly. So what does financial responsibility mean in the context of auto insurance?
It's pretty simple, really. It means making sure that drivers have the financial means to cover the costs if they cause an accident. It's about protecting everyone on the road, not just the individual driver.
So it's about making sure that if I cause an accident, I can actually pay for the damages and any injuries that might have resulted.
You got it. And in South Carolina, like in most states, this is accomplished through what are called compulsory insurance laws.
Compulsory insurance, that sounds serious.
It is. Basically, it means that if you want to legally register and drive a vehicle in South Carolina, you are required to have liability insurance. It's not optional. It's the law.
Oh, so you can't just drive around uninsured and hope for the best.
Nope. Not in South Carolina. You can't. And to make sure that everyone has at least a basic level of coverage, the state sets minimum coverage limits for liability insurance.
What are those minimum limits?
Yeah.
Just so I know what's required.
In South Carolina, the minimum coverage limits for liability insurance are $25,000 for bodily injury or death of one person in an accident, $50,000 for bodily injury or death of two or more people, and $25,000 for property damage.
So those are the bare minimums that everyone has to have, but I'm guessing most people opt to buy more coverage than that, right?
You're absolutely right. Those minimums might not be enough to cover the costs of a serious accident, so it's generally a good idea to have higher limits for greater peace of mind.
That makes sense. It's one of those situations where it's better to be safe than sorry. And it's not just about having the insurance. You also have to be able to prove you have it right.
Absolutely. You can't just tell a police officer, oh, trust me, I'm insured. You have to have proof of insurance with you when you're driving. And you have to be able to show it to law enforcement if you're asked.
I'm guessing there are some pretty stiff penalties for driving without insurance then.
You bet. We're talking fines, license suspension, and even jail time in some cases. South Carolina doesn't mess around when it comes to financial responsibility on the road.
I can see why. It's not something you want to take lightly. Wow, we've covered a lot of ground in this deep dive into the world of auto insurance in South Carolina. From the history of regulation to the complexities of rating and the impact of new technologies, it's a fascinating and ever-changing landscape.
Yeah, it's a complex world for sure, and constantly changing.
It really is. All this talk about big data and new technologies, it feels like we're only scratching the surface of how it's all impacting the insurance industry.
Absolutely. There's so much more to explore. Remember how we talked about price optimization earlier?
Oh, yeah, using all that online data to figure out how much to charge someone for car insurance.
Well, that and the whole issue of information security are two really big areas where big data is raising some eyebrows in the insurance world.
Okay, so let's talk about those. Starting with price optimization, still a little fuzzy on what that actually entails.
Imagine this. An insurance company is using data about your online activities, your browsing history, your shopping habits, how often you buy a new phone, all of that to figure out how much to charge you for car insurance.
Hold on. They're looking at my online shopping and my social media to figure out my car insurance rates. That doesn't seem right.
It definitely raises some ethical questions. The idea behind price optimization is that all this data can help predict your behavior as a consumer.
So it's not really about how I drive, it's about how likely I am to shop around for a better deal or just accept a price increase without complaining.
That's the idea.
It feels kind of manipulative, like they're trying to take advantage of people who aren't as savvy about comparing prices or negotiating.
A lot of people feel that way. There are concerns about fairness and discrimination. Should two people who pose the same risk on the road pay different premiums just because one is more price sensitive than the other?
It feels like they're crossing a line when they start using data that has nothing to do with driving to set my insurance rates.
It's a big debate, and regulators are definitely paying attention. Thankfully, in South Carolina, their regulations generally prohibit that type of price optimization. The rules say that rating factors have to be tied to actual risk, not just predictions about how you might behave as a consumer.
Okay, that's good to know. It makes me feel a bit better knowing that they're at least trying to keep things fair. But all this talk about data collection, it really makes you think about information security.
Right. If insurance companies are gathering all this data about us, are they doing enough to keep it safe?
Exactly. It seems like a hacker's dream, all those social security numbers, driver's license numbers, financial information. It's a gold mine for identity theft.
You're not wrong. It's a huge responsibility for insurance companies to protect all that sensitive data.
So what are they doing to make sure it doesn't fall into the wrong hands?
Well, in South Carolina, they've taken a big step in the right direction. In 2019, they passed the Insurance Data Security Act.
The Insurance Data Security Act, what's that all about?
It sets some pretty tough cybersecurity standards for insurance companies. They can't just rely on basic antivirus software anymore. This act requires them to have much more robust security measures in place.
So things like firewalls, encryption, that sort of thing.
Absolutely. They have to do regular risk assessments, have incident response plans ready to go, train their employees on cybersecurity best practices. It's a whole comprehensive approach to data security.
It sounds like they're really taking it seriously, which is a good thing.
They are. And it's not just about preventing data breaches. It's also about knowing how to respond quickly and effectively if a breach does occur. This act requires companies to notify people right away if their data has been compromised.
So no more sweeping it under the rug and hoping nobody notices.
Exactly. Transparency and accountability are key. Now, let's switch gears for a minute and talk about something a bit more fundamental. Financial responsibility.
Ah, yes, financial responsibility. It's something we hear a lot about, but what does it actually mean when we're talking about auto insurance?
It boils down to this: making sure drivers can actually pay for the costs if they cause an accident. It's about making sure that everyone on the road is protected, not just the individual driver.
So making sure that if I'm at fault in an accident, I'm not leaving the other person stuck with the bill.
Precisely.
Yeah.
And in South Carolina, like most other states, this is accomplished through what are called compulsory insurance laws.
Compulsory insurance, that sounds pretty serious.
It is. It means that if you want to legally register and drive a vehicle in South Carolina, you are required to have liability insurance. No ifs, ands, or buts about it.
So you can't just roll the dice and hope for the best.
Nope, not in South Carolina. And to make sure that everyone has at least a basic level of protection, the state sets minimum coverage limits for liability insurance.
What are those minimums, just so I know what the baseline is?
In South Carolina, the minimum limits for liability coverage are $25,000 for bodily injury or death of one person, $50,000 for bodily injury or death of two or more people, and $25,000 for property damage.
So those are the bare minimums, but I imagine most people buy more coverage than that, right?
You're right. Those minimums might not be enough to cover the costs of a really serious accident.
Yeah.
It's definitely smart to consider buying more coverage for that added peace of mind.
Makes sense. And it's not enough to just have the insurance. You have to be able to prove you have it, right?
Absolutely. If you get pulled over, you can't just tell the officer, oh yeah, I have insurance.
Yeah.
You have to have proof of insurance in your vehicle, and you need to be able to show it to them if they ask.
And I'm guessing there are some pretty hefty penalties for driving without insurance.
Oh yeah, South Carolina takes this seriously. You're looking at fines, possible license suspension, and even jail time in some cases. It's not worth the risk.
It's definitely something you don't want to mess around with. Wow, we've covered a lot of ground in this deep dive into auto insurance regulation in South Carolina.
We have. From the early days of the Friendly Society in Charleston to the rise of big data and the complexities of modern insurance policies, it's been quite a journey.
It's been fascinating. What really stands out to me is how interconnected everything is. The law, technology, consumer behavior, ethics, it's all intertwined in this world of auto insurance.
You're right. It really is a microcosm of the bigger challenges and opportunities we face as technology keeps advancing.
And it's something we all need to be thinking about as we navigate this constantly changing world. But that brings us to our final thought for our listeners to ponder today. With all this data floating around about our driving habits, our credit histories, our online activity, where do we draw the line? How do we balance the benefits of all this data with the fundamental right to privacy and fairness?
That's the big question, isn't it? And there are no easy answers. But it's a question that's worth asking ourselves as we continue to grapple with the implications of big data in all aspects of our lives.
It's a conversation that needs to keep happening. And speaking of conversations, we'd love to hear from you. Be sure to check out the show notes for links to some resources where you can learn more about this topic. And as always, feel free to share your thoughts and questions with us. Thanks for joining us on this deep dive, and until next time, keep learning and stay curious.